Hello, and welcome back to the Lazy Money Game, the channel which is all about getting your lazy money to work so you can be lazy yourself at a later point in life. In today's episode, I will walk you through my portfolio and what has happened within the week, and afterwards I will try and answer some of the questions which I have received from the audience. The first thing you noticed about my portfolio for this week is that there was a red circle for today's episode, meaning that my portfolio have actually lost value within the current week. So if we immediately go to the value tab here, you see that I have lost roughly $400 in capital gains and losses. And I have lost that simply because some of the stocks that I hold are down in value. And if you take a closer look, you can actually see from column H that I currently hold more stocks which are down in value compared to stocks which are up in value. And as I mentioned in some of the other episodes, this is really not something that concerns me, because in the short term you won't be able to predict whether your stock will go up or go down. I believe that I have made some good investments here for the long run, and I am completely confident about keeping these stocks. Even though I, for instance, hold tanker factory outlet centers which are down 16.5%. I still think that I made a good investment. Of course, it could have been timed much better. So why did I choose to focus on the stock I hold which is currently down the most? Well, that's actually a really good reason. I was paid a dividend by that company within the week. So if we do like last time, go and calculate. So we say the dividends times the number of stocks that I own, and of course subtracting the 15% in withholding tax, we see that the amount that I have received into my account is $19.63. And I have of course added that into the dividends tab for February. So far I have made $42.54. And one obvious question one can ask at this point in time is, of course, are you going to reinvest your dividend in this particular company? In this case, I actually chose to go with the Carnival Corporation instead. So the dividends that I have been paid last week and this week, and then I had a small amount in cash on my account as well. I have reinvested all of that, meaning in total $88 into Carnival Corporation. That of course leads to one obvious question. Why did I decide to reinvest in Carnival Corporation instead of some of the other companies in my portfolio? For instance, tanker factory outlet centers. If we then look at the portfolio overview here, we see that tanker is located inside the real estate pie, which is 15.8% of my current holdings, while Carnival Corporation is located inside the consumer discretionary, which is 10.5%. So in order for me to try and balance this out, I decided to reinvest the $88 into Carnival Corporations. The first question I have received goes like this. Hey there, the Lazy Money Game. I have 100,000 DKK or roughly 15,000 US dollars to invest. How should I do that? First of all, thank you very much for the question. Highly appreciated. In order for me to answer this question, there are some important facts that I need to know in order to answer this. Since you are watching this channel, I assume that you have some interest in learning about investments. Depending on your financial knowledge and how much time you're willing to spend, there can be many different answers. So before I try to give my answer, I will list a couple of assumptions. So my assumptions will be something like this. When you say that you have around 100,000 Danish to invest, I would assume that you do not have too much debt or debt that you are paying more interest on than you expect to earn from your investments. Otherwise, I would suggest that you pay down your debt first. Assumption number 2 would be that you do not need the money within the next 10 years. So you will not be forced to sell even if the market drops 10, 30 or even 50% due to volatility. The only reason to sell would be if the fundamentals of the companies that you're owning has actually changed, meaning that you do not see a future potential for the companies that you're holding. And why do I say 10 years? Well, it's just to have a long horizon, meaning that you should feel comfortable going through the next financial recession or economic crisis without feeling tempted to sell, and that's a tough one. Number 3, Just remember, if you're using a foreign broker, you will have to report the tax yourself, meaning if you want to be truly lazy, you will have to use a broker within your own country. So given the assumptions that I have just mentioned, the first answer I can give is also the most lazy. So if you want to be truly lazy, then just invest in ETFs. ETFs is short for exchange traded funds. I would suggest that you buy something which mirrors the S&P 500 or another big market, if you do not want to spend more time on investing. Here you will have the lowest fee for an inactive investor, and if you do not have the desire to know more about investing or spend more time to gain more knowledge, then this is by far the most laid-back approach you can do to investing. And to make it even more concrete, I have listed 3 examples: 2 ETFs for the S&P 500 and 1 for real estate. So the first is VYM, Vanguard High Dividend Yield. Then there's SPHD, which is High Dividend Yield, Low Volatility. And then finally real estate, which is VNQ, also from Vanguard. I will of course never invest my money into something without knowing more in details about it. So let's go in and take a closer look at VYM. If we then go to the web page for VYM, we see that they have basic material, consumer goods, consumer service, financial, healthcare, industrial, oil and gas, technology and telecommunications, and utilities with this distribution. And if we then go to the right here and look at the 10 largest holdings, we see they have JP Morgan, Chase, Johnson & Johnson, Procter & Gamble, Intel, AT&T, ExxonMobil, Verizon Communications, Coca-Cola, Merck, and Pfizer. This, however, only makes up for 26.8% of the total holdings within the portfolio. So if we actually know everything which is inside this portfolio, you have to go to Portfolio Holdings, and then we will see all 398 holdings. In order to make sure that you're not paying too much for this fund, you would have to go through every single holding and applying the guidelines from episode 2, meaning how high is the dividend, how high is the payout ratio, is the current dividend yield above the 4-year average historical view, is there a good moat for this company? I mean, you will probably make it through 1, 2, or maybe even 10 companies if you're really pushing for it. But you will soon realize it will be next to impossible for you to go through every single holding, meaning going through 398 holdings in order to see if you're trying to time it somewhat correctly. So the conclusion you will arrive at is, I'm simply just paying and I'm not sure whether or not I'm paying too much. I'm diversifying my portfolio for not knowing enough. Or as Charlie Munger would have phrased it, Warren Buffett's right hand, you are simply making a hedge against your own lack of knowledge. Remember, if you are buying any of these ETFs, you will have to pay withholding tax unless you are located in the States. And since you can't buy these ETFs through Revolut, you will also have to pay exchange fee on your currency if you don't have dollars directly in your account. And just to elaborate a bit more on my concerns, by buying stocks where you do not know how much you have paid and do not know how much you are owning of the different companies, I am not the only one who had this concern or who have this concern. Michael Burry, who was a hedge fund manager who was able to predict the last financial crisis we had, he actually believes that ETFs will drive the next crash due to these reasons. If you think that the name Michael Burry sounds familiar, then it's probably because you have heard about the movie called The Big Short, where he was a great inspiration. This movie can be found on Netflix and I would highly recommend it, since I find it really entertaining. So that would be answer number 1, meaning the lazy approach was ETFs, and I have stated my concerns with doing this approach, but of course it's up to you to decide on what you are willing to invest in. So if you didn't think that my first answer sounded that appealing, then I suggest that we go look at my second answer. If you have no experience but are willing to put in more time and are interested in learning more, I suggest that you start small and build your portfolio as your knowledge grows and you feel more confident. Since you will most likely make some mistakes in the beginning, I would suggest that you follow along on this channel and learn more as time passes. And to try and answer the question with a concrete example, if you for instance go with a free Revolut account, then it will take you at least 5 months to deploy your $15,000, since you can only do 3 trades a month of up to $1,000. However, since you are not experienced, I would actually suggest that you start smaller, maybe even $500 per transaction, so it will take between 5 and 10 months for you to actually deploy your initial wealth. However, this method will give you more time to do your research and to learn more. And personally, I think that is a greater strategy or a better strategy to do that. Since the viewer is from Denmark, you could of course also just invest in some Danish stocks. There's one thing to notice, however, if you are investing in Danish stocks. I have not been able to locate any broker or any bank where you will pay less than 29 Danish kroner per trade that you are doing. So there will be significant fees if you are trying to diversify and buying, let's say, at least 10 companies. That makes up at least 290 Danish kroner in just fees alone. Another benefit of starting small is simply just to get the right mindset when it comes to investing. So if you're starting small, you're starting to think about how you're actually spending your money. Maybe you will look a bit more in detail into making a budget. And I would definitely suggest that you're not making your budget too tight. The way that I actually did the budget myself was simply to go into my online bank, extracting all my expenses from the last year and then divide it by 12, so I had a good proxy for how much money I would actually spend each month, since there can be big variations from month to month. For instance, for me, I like to go and travel, and that takes a lot of money in that particular month. So accounting for those seasonality variations is crucial when you are making your budget, since we have assumed that you will not touch the money that you have invested for at least 10 years. So how much money should you actually keep as a cash cushion, meaning money that will be available for you to handle unforeseen challenges? Personally, I would hold around 3 months of salary. That's simply because I do not like risk. And if you hold more than that, then you are missing out, or potentially missing out, of some gains from the money, since they're not working for you. If you have less than that, then you might take up more risk. But of course, this depends on your situation of how much wealth you have actually deployed. Because if your portfolio is large enough, then every single month you will actually be paid a lot. So the more you have, the less cash cushion you need. Trying to phrase this a bit differently and using the words of Warren Buffett, it's like breathing the air. It's important that there is enough oxygen, but it doesn't make a difference for you if there's too much oxygen. On the other hand, you really want to make sure that there is enough oxygen. The next question I receive is much easier to answer. Can you share your Google Sheet? Of course. I will be very delighted to share my Google Sheet, and you will be able to find that in the description below. So that concludes yet another exciting week on the stock market. So remember to comment, like and subscribe, and until I see you next time, bye!